Uh, Hello, everyone, and welcome to this webinar hosted by CalcBench and the Valuation Research Corporation on goodwill and intangible assets on the corporate balance sheet and the potential impairment of those assets as a result of the coronavirus, recession, and other business events. I am your host, Matt Kelly. Thank you for joining us. We're planning to go for about 1 hour today, and we are joined by three speakers who will spend quite a bit of time talking about impairment, corporate assets, goodwill assets, financial reporting issues. These are well-informed speakers, so it should be a great discussion. Let's talk about who our panelists are. First, we have Pranav Ghai. He is the co-founder and CEO of CalcBench. Pranav also sits on the board of XBRL US, and XBRL is the data tagging technology that makes a lot of today's sophisticated financial analysis possible. He serves on the CFA Institute's Corporate Disclosure Policy Council. He is a member of the Technical Advisory Board for Microsoft, and once upon a time, he was a financial analyst himself. So Pranav, welcome.
Thanks for having me.
Second is PJ Patel. He is the co-CEO and the senior managing partner of Valuation Research Corporation. PJ is both a chartered financial analyst and an accredited senior appraiser, and he's a frequent presenter on valuation issues and financial reporting issues. So you'll see him quoted regularly in the press regarding valuation of corporate assets. PJ, thanks for being here today.
Thanks, Matt. Pleasure to be here.
And third is Dan Gode. He is a professor of accounting at the NYU Stern School of Business. Dan has taught at NYU since 1998 and has twice been voted Professor of the Year at the school. His primary research areas include financial analysis and valuation in corporate balance sheets. Professor Gode has been published in the Review of Accounting Studies, the Quarterly Journal of Economics, and the Journal of Political Economy. So Dan, welcome to you too.
Thank you, Matt.
Let's go on and take a look at our agenda. As I said, this webinar is scheduled to run for 1 hour. It will follow roughly as follows. First, Pranav will talk about goodwill generally. He'll introduce the topic to us and present some data about the overall size of goodwill assets and impairments, the sheer dollar amounts that we're talking about, historical averages, interesting outliers, and so forth. Then we'll look at what impairments might mean for corporate reporting, why they are significant, how analysts should think about impairments and goodwill assets as you're looking at the companies that you study. Third, we'll talk a bit about how coronavirus specifically has driven some turbulence in impairments, because coronavirus is definitely a significant event, and that can trigger quite a lot of consternation in financial reporting. So we'll look at some examples of how significant some impairments can be and how influential and important goodwill can be for the corporate balance sheet generally. And then we'll fourth talk about the future of impairments, since at some point, coronavirus will fade as a one-time disruption. And let's not forget that some sectors and firms have already had goodwill accounting be a significant part of the balance sheet for many years, and impairment has always been something on their minds. So will there be some sort of return to a baseline normal in goodwill and intangible assets and impairment, either in 2020, 21, or years in the future? And then we will also try and set aside, for the last 10 minutes or so, some Q&A for the listeners. So please do have your questions ready to go. Speaking of questions and other housekeeping items, first, to keep the conversation orderly, all attendees other than our panelists have been placed on mute for the hour. If you do have a question, please submit it at any time using the Q&A function on the bottom of your screen. We may try to answer questions during the hour if they are especially on point to something that's being talked about right then. If not, then, as I said, we'll save up the questions and we will go through them for probably the last 10 or 15 minutes of this webinar. If you have any technical questions, you can ask those too, and then one of the technicians here behind the scenes will follow up with you directly. We don't offer any continuing education for this webinar, and yes, it is being recorded. So those are the housekeeping details. And with that, we can begin. First, Pranav, I know that you're going to walk us through some background on Goodwill in general and give us some examples and some data showing why Goodwill is so important. So Pranav, take it away.
Thanks. Thanks for the introduction, Matt. Can everyone hear? You can hear me, yeah? The audio is
Yep.
okay? Okay, thank you. So today we're just going to sort of, in the first few minutes, lay the framework for what it is that we're talking about and explain how we at CalcBench get some of this information and what it means to all of you as you go about in your daily lives, hopefully using it. So Goodwill, you can pull out an old textbook if you still believe in textbooks and get a good definition for what, or a very basic definition for what it is. It's just the premium paid for an acquisition of intangible assets. And that, what we'll do is now we're going to say, okay, let's look at one specific example of that. And then we're going to extend that example out and show you the magnitude of the issue that we're talking about. So 4 years ago, this is a famous one. People heard about it. They saw the headlines. Microsoft bought LinkedIn for a whopping $26.2 billion. So you see the headline and you think, wow, okay, good. So they paid $26.2 billion. It was a 50% premium from the prior night's closing price of LinkedIn. People that are, that own LinkedIn stock, like, wow, I made that much money overnight. Terrific. The Wall Street Journal puts it in the headline. Terrific. What does that really mean? So if we go to the next slide, we'll see that the deal was announced in June of 2016. You then see here in the first breakdown of the deal, that actually closed 6 months later in December of 2016. It's right there in the footnote. This footnote became public on January 26th of 2017. So it's a full 7 months after the actual deal was announced, a full month plus after the deal closed. And you see, yes, of course they paid $27 billion. Well, what do they get for that $27 billion? You see a table of the breakdown. So yes, of course they get the cash, they get this, they get that. But if you notice, the fifth or sixth line down is Goodwill, and it's a whopping $16.8 billion. So they paid $16.8 billion for this thing, right? You can't touch this thing. It's not like it's an oil well or a piece of software that you can actually pull off the shelf, or, it's not there. They just paid it. And then in addition to that, there's a $7.9 billion in intangible assets that they bought through this acquisition. So, just back of the envelope math, it's close to 90% of the acquisition is in these two items, right? So just hold that in your head for a while. And now the other thing is January 2017 is the first time you're actually learning about any of that. It's not in any prior document. So next slide. Next, this is now the 10K, which is filed, the audited financial statement, which is filed a year after the acquisition, right? So this was announced in June of 2016. Here we are filing it on August 2nd. So now you're getting a little bit more. This has been audited. And when they audit it, you can see now the purchase price has changed slightly from the 10Q. It's a rounding error, but it's changed. And some of the other items have changed as well. So just to point out that there are differences between the 10Q and the 10K. These things happen, but again, mostly a rounding error. Next slide, please. So we're going to now say, okay, $16.8 billion of goodwill represents 62% of the total purchase price. It's breathtaking. And there are a lot of breathtaking things we're going to see as we continue on this journey this afternoon. So, and again, we point out the 7.9 billion in intangibles. It's over and it's on top of the 16.8 billion in goodwill. So, okay, this is one acquisition. People might be saying, look, I don't know, guys, this one acquisition, one data point does not a trend make. Can you please show me what it looks like across all companies. So we took a stab at that. So you look at the S&P 500, every single company, and we can look at a point in time, which is the end of 2019 for all their filings. We can ask the question, how large are these goodwill balances? Now, before we get to that, most of us know that mergers are problematic. They cause issues. You've got to merge cultures, you've got to merge systems, you've got to do all of these things when you do this. And the data tells us that most mergers fail. And when most mergers fail, you know, the estimates are somewhere between 60 to 75% of mergers fail. That immediately poses a question to all of us, which is, okay, if you've got these balance sheets that have all of these assets that are now coming due, how much balance sheet risk is there? And so we're going to try to, the next slide will show you how we try to quantify that risk. So let's go on. So at the end of 2019, and this is where we need the drum roll, there was $3.4 trillion of goodwill on S&P 500 balance sheets. You can see it right there in the bottom picture in the middle column, right? So the total of 3.4 trillion. Think about that for a second. 37 trillion in assets exist on these balance sheets. So you're talking just below 10% of all assets in the S&P 500 are in this thing called goodwill. To me, that was sort of a head scratcher. But this to me is the more, the next thing is even bigger. And that is that you know, people like Warren Buffett say, oh, you need to look at book value, and book value is everything, and et cetera, et cetera. Well, nothing against any of that view of the world, but $8.4 trillion in stockholders' equity or book value exists in the S&P today. 3.4 trillion, again, is in goodwill. So you're talking about 42% of book value is in goodwill. And so now, like, connecting the dots here, we start to see, like, whoa, this is a big deal. You're telling me that as I do valuation, as I monitor companies, I really need to be taking this into account, right? So next slide.
Pranav, maybe I could step in just for a minute. You know, it's very interesting, you know, working on deals as we do, and, you know, we work on a lot of them, you know, 500 or 600 a year, and working with public companies and private companies, and aging myself a little bit. I've been doing valuation work in this area for 25 years now. It's sort of reflective of the world we live in. You know, it's when I look at, you know, financial statements for, say, a consumer product company, and you go back to the 1980s, and their margins were 10% or so. You know, in that situation, the vast majority of the value was tied up in working capital and PP&E. But you fast forward to today, and that same consumer product company is generating operating margins of 25%. Its working capital levels on a percentage of sales basis are lower. The PP&E on a percentage of sales basis is lower. What you have is intangible assets. It's brands, it's goodwill, it's customer relationships, it's IP of different sorts. I mean, those are the things that are driving the market and differentiating companies and products. And, you know, it's really reflective of the world that we live in. Yeah, you know, just one other thing that I would point out is, you know, you were talking about sort of, well, what is goodwill, and, you know, what is it made up of? And, you know, there's some basic things like, you know, going concern and workforce and future assets and things of that sort. But when you look at the LinkedIn Microsoft deal, I think a big component of that is the synergies. It's the value that Microsoft can get out of a company like LinkedIn with its existing products. Maybe it's dynamic CRM, you know, and the benefits that you get from those sorts of things. So it's oftentimes I think it takes a little bit more digging. But I know that you know, as we're doing valuations, one of the things that we're always asked about is, okay, you've got this big amount of goodwill. What does it relate to? You know, how do you rationalize it? And I think that's a really important part of the process.
Dan, we'll get into, I'm sorry, PJ, we'll get much more into how you do the valuation of it. I know, Pranav, you had one or two other slides you wanted to get through here just to set the table for us.
Yeah, no, all of these things are true. I mean,
Yeah.
it is all in, you know, like the post deal execution and what all of that means. There's no question about it. It's just if that post deal execution doesn't actually materialize, there's some real risks here, right? So that's what we're trying to say. And so if we go to the next slide, you'll see it, right? So it isn't just us outlining these sorts of observations here. And so far, that's all they are, right? These are just observations. They happened in the past, but they do have an impact on the future. And so if you're interested in reading more about this, I would really recommend the CFA Institute comment letter that they sent to the FASB in January of 2020. Full disclosure, as Matt said, there's the Corporate Disclosure Policy Council that I sit on that advises the CFA on matters like this, advised the CFA on the letter, but it's their letter. And it's, you know, this is a public letter. The footnote number 2 shows you how you can get it, or you can just do a Google search on CFA Institute, Goodwill, comment letter, January, FASB. The point is that here, the numbers that I quoted before are, they held constant. You know, in 2018, goodwill to equity ratios for all public companies with goodwill is still about 40%. That's for over 3,000 companies in the observation set, right? And so you can look at this, and again, it is what it is, right? The data is real. It's breathtaking. So again, we can just go to the next slide. The next thing is, you know, you want to look at asset impairments, and these guys know much more about this than I do, but I'm going to tell you right now, what we see in the data on the asset impairments in the S&P are that, you know, you see this graph here, the bars move to the left-hand axis, so the left-hand y-axis. So in 2016, you had about $25 million in impairments by 76 firms for, you know, somewhere a little over 300 million per firm in impairment. That rose all the way up to about 80 billion in impairment in 2018 for 77 firms. So $1 billion in impairment per firm. Last slide is where we are in the first 2 quarters of 2020. And that shows you 66 and 47 firms in each of the 2 quarters, respectively, with an average, you know, in the first quarter of about $1 billion in impairment, and then it's lowered in the second quarter. So these are numbers that we'll keep track of as we progress through the year. And with that, I think we've set the table to, you know, talk about what all of this means. So I'm done for now.
I think, Dan, we wanted to turn things over to you a bit. If you could just briefly talk to us about the cousin of goodwill, intangible assets. Clearly, they are a significant part of acquisitions too. So if you maybe could just take a few minutes to discuss how intangibles do and don't relate to goodwill, what should financial analysts know about this topic? What are your thoughts here?
Thank you, Matt. I was listening keenly to Pranav, and he uttered the magic phrase, "You can't touch this thing." So every time I hear it, I keep thinking of MC Hammer. And whenever intangible assets come up, is something people say something you can't touch. Well, you can't touch receivables, but they are not intangible because they are a financial asset. So although FASB has this definition that intangible asset is something you can't touch, but it is not a financial asset, I tend to think of intangible assets as those assets that have highly uncertain benefits or difficult to value, difficult to quantify benefits. And that's why companies are not allowed to show intangible assets that are internally generated. So if you have a patent, copyright, brand name that you have created organically, it doesn't show up on the balance sheet. But when you get acquired, the acquirer has to show that asset on the balance sheet at fair value. Now, following up on what PJ had said about synergies. So LinkedIn has these intangible assets like customer relationships and so on. And if those are valuable, they should be listed on the balance sheet, and that should not really increase goodwill. But when there are company specific synergies, that cannot be reflected in the fair value of these intangible assets, because these assets are supposed to be valued from an independent third party market participant's perspective. So any extra value you paid for them because you can benefit from them more than others in the market can, ends up in goodwill, not in the value of the asset itself. So the valuation has to be from the perspective of third parties. The reason we have seen an explosion of this, and this is further following up on what PJ had said, is we have an explosion in the knowledge economy, and what you're paying for is either employee skills that don't show up as any asset and therefore are part of the goodwill, or they are patents and copyrights and brand names and so on that do show up as intangible assets. And if you look at the American economy, because of public policy, antitrust regulation, or otherwise, there has been concentration of economic power in companies, and this has been a 30-year phenomena. And that partly explains why we see margins exploding all across the board for S&P. And when that happens, you're going to see a lot more goodwill, not just intangible assets. And then if you look in the tech space, there are these company-specific synergies because of the fit between technology products. Harder to achieve those revenue synergies in traditional companies, and you end up with, again, goodwill in this case. And if you look further inside intangible assets, there are finite life assets such as patents and indefinite life assets such as brands and trademarks. And the real issue is finite life assets are amortized, whereas indefinite life assets and goodwill are not amortized as of now. I had a bet with several people when the standard was passed. I said between 10 to 20 years, they'll come back to amortizing goodwill because it's just too painful to do all this impairment testing, and companies will say, just get us out of this mess. This is too much work. And I think we may be heading there as FASB and others deliberate. They have, in fact, given private companies an option to amortize goodwill and do a lot less work with goodwill impairment testing. But the allegation is companies try to shove the assets into intangible assets with indefinite life and goodwill because you won't see an amortization charge. That is tempered by the fact that this amortization doesn't affect EBITDA. And to the extent you're using EBITDA to value companies, doesn't matter whether it is amortized or not. Then there is the optics issue of, will this showing 60, 70% goodwill make it look like that you overpaid? And there is some concern around that. But one has to really think about finite life, indefinite life intangibles, and what remains is goodwill. And finally, some people erroneously think that if you amortize these things for book purposes, you'll get a tax deduction. Most of the deals are not taxable to the acquired entity, and therefore there is no tax basis in these intangible assets or goodwill. So whether you amortize them or impair them has no effect on taxes. It does have effect on deferred taxes for intangible assets, but not goodwill. So this is sort of the big picture perspective of how intangible assets differ from goodwill here. And I will stop here and hand it over to you, back to you, Matt, for further discussion. I'll come back and discuss goodwill a little bit later.
And then I think, PJ, we were going to turn things over to you a bit to talk more about impairments and valuation around goodwill generally. Where do they come from? How do you figure them out? And then specifically, how has coronavirus really given us all a kick in the rear on these issues to think about impairments? I know we can also talk at length about what FASB may or may not do with goodwill calculations and impairments, but give us the rundown here from your perspective, PJ.
And let me first respond to Dan. Dan, I think the FASB and accountants in general have been trying to figure out since the beginning of time what to do with goodwill, right? Amortize, test for impairment, and every 20 years or so, they seem to change their mind on how, goodwill should be accounted for. So it's not surprising, and who knows? 20 years from now, it may change again. Maybe I'll just step back also and talk a little bit about something that Pranav had mentioned with regard to acquisitions and sort of what we see. Where do impairments come from? I think depending on the time period, it really just depends. What we get to see, working through the life cycle of a deal, is that in the first, call it 1 to 5 years post-acquisition, the impairment really results from, call it overpayment, maybe a misunderstanding of value. It's really, part of the deal-making process is what we see. Again, we get to see a lot of different deals, so it's a big sample size. And at the time of the deal, everybody's really happy. We won, we did the acquisition, it's great. And you get about 6 months in and you go, uh-oh, what did we acquire? Not quite what we expected. Diligence didn't show us, uncover all these stones. And so now it's a lot of work, and that work continues for probably 2 years, in my opinion, where you refine the operations, you figure out what you have, and you try to move forward. Once you get to about 2.5 to 3 years post-acquisition, that's when we really start to see impairments or on the path to no impairment. And it's not in the first couple of years because you're still figuring out what you have. And so once you get to, call it year 3 and beyond, that's typically where if you have an impairment, it's not necessarily relating to the acquisition per se. It may be relating to how management has managed the business post-acquisition. Have they invested in the right products? Have they done enough R&D? Have they been able to achieve the kind of synergies that they were thinking about at the time of the deal? There was a question that came up with regard to coronavirus and the impact on impairment testing. And what I would say is beyond year 5, many times when you have an impairment, let's say you did an acquisition, in 2010, here we are 10 years post-transaction, and there's potentially an impairment. That may be due to a situation like coronavirus, where there's a broad scale impact on the economy. We saw this during the Great Recession. There were many transactions, a lot of goodwill that was impaired in the 2008 through 2010 time period. But it was more broad-based. It was, acquisitions that seemed that as though they were good, but quite frankly, values change. In many cases, significantly values changed. And so as a result of that, goodwill was impaired. So I think, when you ask the question of where do impairments come from, it depends. It depends if you're talking 1, 2, 3 years post-transaction, or are we talking about 10 years post-transaction? In terms of impairment calculations, the FASB has sort of been chipping away, I would say, at the approach on how to calculate impairments over the last 10 years. There's really been a simplification of the process. I think there's a little bit of confusion because there's been so much change. But when you look at the tests today, it's actually very simple. You calculate the fair value of the reporting unit. You compare that to the carrying value. If the fair value is less than the carrying value or the carrying amount, you have an impairment. It's pretty simple. And the impairment is the full amount of the difference. Now, you do have to look at and make sure that there aren't other assets that are impaired, but quite frankly, if you've got fixed assets that are impaired, or yeah, let's say a brand that's impaired, you know about that. You don't need somebody to do a test to figure that out. You know that that business is struggling, and so it becomes pretty straightforward. So, yeah, what I would say today is that those impairment calculations that maybe seem so difficult 5, 10, 15 years ago really aren't that difficult today. Pretty streamlined.
PJ, let me ask one question of you, and maybe Dan and Pranav as well. Pranav had shown some data before about the number of impairments over recent years, and it was somewhere in the realm of the 70s, 72, 75, over the course of a year in recent years. And then along comes the first quarter of this year, where we had 66 impairments just in Q1. And I know that most companies review their goodwill and do a test for impairments in the fourth quarter of their year, which for most companies is the fourth quarter. It's now. But we had that big spike at the beginning. But I'm wondering, are we going to see an even bigger number of impairments now that we are in the traditional testing period of fourth quarter, so that 2020 is just going to be off the charts with impairments, thanks to the pandemic or recession or whatever? But are we likely to see something like that?
I don't think so, Matt.
Okay,
and I'll
why not?
explain why.
Sure.
Yeah. So I think if you're talking about travel, tourism, retail, those were the kind of impairments we saw in Q1 and Q2.
Yep.
It wasn't broad-based. And in fact, when you're talking about public companies, I was a little surprised that impairments weren't higher than what they actually showed. And the reason for that, of course, is that the stock market has held up. And so even though you may have companies with reduced earnings, they don't have reduced value. And so and the recovery was quite quick. Quite frankly, having lived it, we got a lot of phone calls at the end of March, the beginning of April, saying, "Oh my God, what are we going to do? The stock market, has crashed." It happened so late in the quarter, though, that there wasn't enough time. And as you, if you follow sort of best practices in April and May, there was this thought of, oh, you'll run multiple scenarios, and it'll be V-shaped or W-shaped or K-shaped Nike swoosh-shaped recovery. There was all kinds of different theories out there on what the recovery might look like and how companies would have to run scenarios. But quite frankly, the stock market held up, multiples held up. And so as a result of that, we really didn't see much in the way of impairment. I would also just point out one other thing. Pranav showed a slide that I think in 2018, there was a significant uptick in impairments that really related to two companies.
Yeah.
Kraft Foods and GE. And so, just massive amounts of impairment in both of those companies that really caused an uptick in the amount of overall impairment that we saw in the market.
Yeah. Dan, do you have any other thoughts about coronavirus and its effect on impairment, or the lack thereof, even? Because it's, coronavirus, it's supposed to be the end of the universe, and the end is nigh. But is that, what do you think of its big effects on this sort of an issue?
So if you contrast coronavirus problems with credit crisis problems,
sure.
Credit crisis was seen as a much more structural issue with the economy, with some long-term adjustments happening to valuation. This is viewed as a problem that may be severe for companies like airlines and hotels, where people switch to Zoom permanently or significantly, and they get affected. But outside that, it hasn't been a structural problem for the economy as yet. Now, this continued unemployment, if it leads to that, we don't know, but it hasn't happened. And we have had such drastic cuts in discount rates that if you say, okay, the earnings and cash flows are going to dip for some time and going to recover, then you start to do even your own DCF model, you don't see such a big valuation drop. and then you don't have to make that many impairment adjustments. So that's what is going on. The sense of panic that prevailed in the credit crisis, but in some sense more serious. This was a short, severe panic for 1.5 months with COVID. It hasn't, then the market said, okay, some people will get affected, but the rest of the economy seems okay. Only time will tell. But the 0% discount rate also helps when you're running any kind of valuation model and you don't see the impairment, the fair value holds up.
We wanted to move on now to a couple of specific examples of companies that are carrying a lot of goodwill on their balance sheet and what that should mean for financial analysis. So the first one that we had came across was Analog Devices. I know, PJ, you were going to walk through your thoughts on that. Take it away.
Yeah, Matt, very briefly, I think when you look at Analog Devices and such a, they've got 12.2 billion of goodwill. It's 50% of the assets. A lot of that goodwill relates to a single acquisition. How the company manages the impairment testing process and whether an impairment exists or not is extremely important. And I think, as I've talked to the FASB about issues around goodwill, I think this is sort of a prime example of a company that does an acquisition like this will spend a lot of time communicating about how this acquisition is going, what they're seeing, what the outlook is, and any, turbulence they see going out to the future. And so I would say that the impairment testing process for a company like this is extremely important. Maybe I'll step back just for a second. There was a question that was asked, and maybe one of the points on the prior slide around, the FASB deliberations around impairment testing. And
sure.
As Dan pointed out earlier, it seems as though they're really moving down the path of amortization of goodwill. I think the devil's in the details. I mean, over what time period are they going to amortize? Is it going to be capped? Is it going to be a fixed period? Is it going to be management's estimates? There's a lot that needs to be determined still. But I think as you think about that, and as the FASB continues to think about that, there's a balancing that has to go on. As I pointed out earlier, in the first 5 years post-transaction, and definitely the first 3 years post-transaction, the impairment testing process is extremely helpful to users of financial statements in understanding how an acquisition is going and whether it'll be successful or not. As you move out further and further, of course, it becomes less of an issue. The question that was asked has the impact of coronavirus maybe changed how the FASB or others are looking at the impairment testing process? And I don't think it has. I mean, I think that coronavirus and the impact on valuations and impairment testing to this point has sort of been negligible. I think the Great Recession had a much bigger impact.
Okay.
Yeah.
Dan, do you have any quick thoughts about how FASB could handle amortization or where it might ultimately go with this? I mean, we should all note that right now you can't amortize, so we're somewhat having an academic debate about it. But Dan, you're an academic, so what do you think in just a minute or two here?
See, they have floated a trial balloon with private companies, allowing them to amortize over 10 years.
Yeah.
Now, 10 years might be short. In early 2000, it was 40 years is what the companies used to do. And I actually asked somebody, where does the 40 years come from? And I'm not mocking anybody. This was his answer. He said it's biblical in origin. So that's what I was told, that 40 years was long enough for Moses, long enough for Goodwill. So that's where it came from. So we have gone from 40 years to 10 years. Like PJ, I'm showing my age here. Year 2000 looks like yesterday to me. But I remember attending a conference at Goldman and taking a bet with people that, give it some time and we'll be back to something simpler. So 10 years seems pretty extreme to me, because some of these companies do have very valuable employees. That what the whole living, breathing organization is what you're paying for. And even if those employees leave, the system is in place to replace them with other good employees. And so it's a living, breathing organization whose value is not tied to a specific individual. And to say that it should be amortized seems an unnecessary charge to earnings in some ways. So I don't think there is inherently anything wrong with the impairment model other than the amount of work it entails, which, as PJ pointed out, they have simplified significantly in the last couple of years. It used to be a much bigger nightmare. So I'm not sure. I think there'll be pushback from companies as they require amortization. So why are you asking me to write down something that doesn't lose value, unless there is an evidence in law of loss in value? So we'll see how it goes. There will be balancing of simplicity against economic realism.
Now, Pranav, I wanted to circle back to you because we have another example of goodwill here with a firm called Roper Technologies, very different than what we just saw with Analog. Walk us through what we should be thinking through here with a company that's doing it this way.
Yeah, so we, the way we got to this one, we didn't okay, so it looks like we cherry picked this one, but the fact is, if you just do some simple screens, if you start with, the question of who's got the most goodwill relative to book value or assets, these guys come right to the tops, and they're like, okay, all right, so their goodwill is over 100% of their book value. So that means in the event they were to write the whole thing down, it's a negative net asset value. So then when you look a little bit deeper, you realize that this company has been acquiring other companies for the last several years. We have 15 acquisitions going back in the period up to 2017. I think it's more like 12 or something like that. But it's actually 25 acquisitions since 2015. So that's pretty serious, right? So I mean, maybe they found bargains. Maybe they were, they needed to build certain businesses up. And I don't have any knowledge of this company other than what I read in the statements and that we collect. So there's no value judgment here. This is not a recommendation to do anything here with this company, but the fact is they are a serial acquirer. And so, you'll find things like this where, and the fact is, look, all of us on this call are part of the knowledge economy. So the more companies we find like this, the better it is for all of us, because, hey, look, we can examine, we can analyze, we can collect data, whatever it is we do. But these goodwill balances are up. Their profits are not significantly up, by the way. So, it is what it is.
Well,
it's
it's
very interesting use case.
That a company like this, if this is their balance sheet, then what becomes important to make it more valuable? It's like their ability to integrate companies, multiple acquisitions at multiple integration phases at the same time. They've got to be juggling so many different balls in the air all at once. Like that's becomes super important to uphold all of this goodwill. And I don't know, maybe PJ, if you could just talk a little bit about that, because as we said, most acquisitions, they don't really live up to the hype in the press release. So I look at this and I'm thinking, yeesh, man, this has got to be a tough row for a company to hoe. Like we said, we don't know Roper from a hole in the wall. I'd never heard of them until I found these numbers. But PJ, what would you think about what becomes important to pull something like this off?
Yeah, there's a lot there, Matt. I mean, I will say that I struggle with the statistic that most deals don't work out. As I pointed out earlier, I would agree that 6 months after an acquisition, the vast majority of times companies go, uh-oh, what did I acquire? Not quite what I thought. Okay, but fast forward, 3 years, are they still saying the same thing? I don't think so. I mean, the companies I work with have big corporate development groups. They're out there doing acquisitions. And yet you fast forward, a number of years, those acquisitions help diversify the company, help reduce their cost of capital, give them resiliency in a time period like this. So I'm not so sure about that. Again, I don't know a whole lot about Roper, but what I would say is that they're trading significantly above book value, and so it seems to me that it's I don't know a whole lot about the acquisitions that they've done, but they're looking here, their market capitalization is 45 billion. Market capitalization 44 billion, enterprise value is 48 billion. They seem to be doing fine. So I would say that you can get caught up maybe in some of the minutia of there's significant goodwill resulting from the acquisitions, but judging by their growth and profit margins, it seems okay to me.
All right. So we're going to move to questions in just a couple of more minutes, and we just wanted to have some wrap-up thoughts here. And Dan, maybe if we'll shift the conversation back to you again, where do you see the future of Goodwill assets going? Like, are they just going to keep increasing in importance to the corporate balance sheet forever? What do you think?
Yeah, I mean, the fact is we don't amortize these assets. So there is no way to remove them unless there has been some bad outcome and we therefore have an impairment. And so as you shift to companies developing human capital and not recording human capital or internally generated assets on the balance sheet, you're just going to see, especially in the tech sector, a lot more goodwill.
Mm-hmm.
And as long as companies keep paying for synergies and workforce, this is going to continue to happen. And this is going to be further aided by the fact that, especially in the tech sector, companies are sitting on a lot of cash with no reasonable way to deploy it. So they may be tempted, especially at current valuations, to still go out and do acquisitions. And if they do, they're going to end up with a lot of goodwill. So I don't see goodwill going down unless FASB just mandates some kind of aggressive amortization.
Sure.
Which I'm not sure is the right thing to do.
And he's absolutely right about that. I mean, you're talking about a market environment where, there is no alternative, right? There is, you can sit on your 0% cash, or you can go and do something. And we know the bankers are out there hustling deals still.
Mm-hmm.
Software companies have cash. Financing is cheap if they want to go get it. The cost of capital is low. So they're going to keep doing it. It's really that simple, right? And management is incentivized on both sides. So you're creating this system where, M&A will just naturally happen because there's nothing else to do.
So we've got 10 minutes left here. I did want to get to some of the questions that listeners have been submitting. So in no particular order, but I'll start with the first one here. Somebody asking, could the panelists comment on whether the pandemic has informed their opinion about FASB and whether goodwill could be derecognized? In other words, has the current state of the world made you change your opinion on whether amortization or impairment is the more appropriate model? Dan, you're the accounting professor, so I'll start with you, and then PJ and Pranav. I don't know if you have thoughts as well. But Dan, what do you think there?
From a theoretical perspective, I don't see a justification for amortizing something that is not declining in value.
Mm-hmm.
So I don't think that basic premise changes. Now, some things FASB does for accounting convenience. So if you move into 10-year amortization like they have for private companies, as I said, that's a trial balloon. And they realize people don't care one way or the other. We just get rid of this pesky asset over time. It's just better for everyone involved. And well, that's saying earnings don't matter or goodwill impairment doesn't matter. So that will be a tough call to make. I don't think coronavirus, we are in the middle of it now, but it will eventually come to pass. And it's not going to fundamentally change our evaluation approaches, as severe a shock as it may have been to the economy and people involved.
Okay.
I don't think it's conceptually any different than previous shocks.
Here, we've had a couple of people asking a similar sort of question. I'll try to boil it all and maybe PJ put it to you. Is there any way we can identify or estimate the risks of overvaluing goodwill?
The risks of, oh, no,
Any metrics?
I think, yeah, no, I don't think so. Look, we look at Goodwill. We work with CalcBench to, come up with transaction data. I think we've got 10 years of data where we look to try to benchmark levels of goodwill, and you can see some patterns, but every deal is unique in its own way. So I think it's difficult. It's dependent on the premium that you pay, the price that you pay, what assets are being acquired. It truly is the residual, even though we can rationalize it qualitatively in terms of what the components of goodwill are. So I think it's difficult there. I think you looking at the deal that was done to create goodwill and what was paid is a better way of sort of rationalizing that.
Sure.
I would like to add two things to that. One, if you're teaching goodwill and goodwill impairment, the classic case to look at is America Online buying Time Warner, where out of 146 billion, it was 126 billion of goodwill. And then the new accounting standard was adopted and they wrote off 100 billion of it. And to this date, I think the net income of minus 99 billion that the America Online Time Warner Group reported is probably the largest loss ever recorded. Maybe AIG over 2 years had more, but single year, that is the largest loss recorded. And if you ask somebody who won and who lost, America Online bought Time Warner, they booked huge amount of goodwill and write it off. Didn't America Online lose? And the answer is no, it's the Time Warner that lost, because America Online did a stock for stock deal and their stock was ridiculously overpriced. So it seemed like there was a lot of goodwill. And then the stock price came down. When the dust settled, they ended up with a bigger percentage of a real asset company than they should have ended up with. So in that case, when you have stock for stock deals happening in an inflated market, it's totally unclear who is overpaying for who and who is getting hurt by that. So that's one question. Because I was asked to comment on it back in 2003. And I said, this is kind of market driving goodwill rather than goodwill driving market. And then the other deal you mentioned was GE. And I remember GE buying their, I forget the European company.
Honeywell. No,
the energy company, it will come back to me, but the gas.
Baker Hughes? Not
no,
Baker Hughes.
It's a company I know well.
Alstom?
Huh?
Alstom?
Yeah, Alstom. They bought Alstom. And I remember looking at the disclosure where they had paid 15 billion to buy the company and the goodwill was 17 billion. So if you did net fair values because of pension and other things, it was minus 2 billion. And you say you are buying an old line company. It's not a new line company where you're buying workforce and other things. What the heck did you pay for? And you paid in cash. It's not like you paid with inflated stock. So we are in the America Online world. You've dropped hard cash by borrowing money. And I asked like 5 or 6 equity analysts that follow that company. I said, what could GE do to justify this? And I never got a straight answer. And because there was no justification, they ended up writing it down or writing it off, in fact, entirely, pretty much a year later. So there are some deals that you really scratch your head and ask yourself, what am I looking at here? What am I missing? And either it is stock for stock deal and the stocks are crazy multiples, or you've just been very stupid. So whenever I'm asked, I say Goodwills reflect synergies or stupidity. You don't know which S you're looking at. But one needs to be careful there. So there are some things that stand out. On average, I agree, it's hard to tell. But within specific deals, it's kind of, and no one questioned GE. I listened to every conference call transcript as a part of a project. I listened to every conference call and I listened keenly. Nobody had questioned this deal that you end up with minus 2 billion fair value and you drop 15 billion on it. So it's 17 billion in Goodwill. What's going on? What did you really buy?
Pranav, do you have any other thoughts there about how to try and suss out whether a Goodwill deal is structurally flawed or strategically a bit stinky?
These things are really easy after the fact to do. I mean, I'm just a natural skeptic. I just am. But so part of that is, you know, like the Roper example, you look back on it and I mean, look, my bias is going to be evident here. I looked at that and the first thing I thought of, and this will date all of us too, was Dennis Kozlowski, right? So if those of you that might remember, you know, this is the guy who ran Tyco. And I'm thinking to myself, holy cow, this many acquisitions in this short a time period. I'm just looking for the, what was it? The golden shower curtain. I was waiting for that. Right? So.
And then we have time for maybe one last question. I'll try and sneak this in. And PJ, this might be best suited for you. Somebody asking, some industries, such as financial services, are trading below book value as of September 30th. Banks are an example. They've been trading below book value for several quarters, yet there are not as many goodwill impairments. Any thoughts on why that might be?
Yeah, I can't speak specifically to banks, Matt. That's not an area that I focus in. But, you know, I will say that we have not seen much in the way of goodwill impairments outside of travel and tourism and retail and things of that sort through Q1, Q2,
yep,
and even Q3. As we approach the end of the year, though, as you pointed out, it is impairment testing season, and we are getting involved in many more of those sorts of calculations. It's interesting right now, it's probably more with private companies than public companies. With the private companies, they don't have a stock price or market capitalization that they can look at.
Mm-hmm.
With the public companies, you know, I think there's more assessment going on, probably more internally. But if the stock market were to change dramatically between now and the end of the year, I think you would see a ton of new studies and potentially impairments being taken.
All right. Well, that's pretty much all the time we have here for the hour. So PJ Patel, Dan Gode, Pranav Ghai, thank you all very, very much. It's been a great discussion. And thank you to all the listeners who have dialed in today and hung with us for the hour. We really appreciate all the time. And everybody, if you have any other questions for CalcBench or for valuation research, you can track them down there. And otherwise, thank you all for listening and enjoy the rest of your day.
Thank you, Matt.
Thanks, Matt.